Okay, great. Let's get started. A few more people are logging in, but we have a lot of content to cover. I am Marilyn Turner, Senior Director of Development here at Food and Friends. Really pleased to be able to host this webinar again for our community to engage with our great supporters, Lars and Eric, with their incredible knowledge on estate planning. Just a little bit of housekeeping for tonight. All of the attendees are on mute, but we really encourage, again, that dialogue and connection and questions. A lot of people sent questions as they registered, but please feel free as Lars and Eric present. If questions pop up, please put them in the Q&A box. We can, pop some in as we go along, but also there'll be time at the end for lots of questions to be asked. Without further ado then, I'm going to turn things over to Carrie Stoltzfus, Food and Friends Chief Executive Officer.
Hi, good evening, everyone. As Marilyn said, I'm Carrie Stoltzfus, CEO of Food and Friends, and it's my pleasure to welcome everyone joining us for tonight's webinar called Securing Your Future, Tools for Your Financial Planning. So thank you for spending the next hour with us, and thank you for being part of the Food and Friends community. With your support this year, Food and Friends will provide 2 million meals to about 6,000 seriously ill community members. I am particularly honored to introduce our two presenters tonight, Lars Etzkorn and Eric Lantz, two longtime Food and Friends supporters and volunteers who have generously volunteered their time and expertise for the webinar. Lars is the owner of Lars Etzkorn Law, PLLC. His law practice focuses on estate and life planning, trust and estate administration, charitable giving, and governance. Lars works with individuals, couples, and families, and with local and national cultural, education, and health organizations. Eric is a financial advisor at Ameriprise Financial Services with 26 years of industry experience. His professional qualifications include the CFP, Certified Financial Planner Certification, and the RICP, Retirement Income Certified Professional Designation. It's important for everyone, regardless of age, to know the estate and financial planning tools that Eric and Lars will share with us tonight. So without further ado, I will turn it over to the two of them, and thank you both for all you do for Food and Friends.
Good afternoon. It's nice to be with you today. And let me start by thanking you for supporting Food and Friends. I know Food and Friends could not do its good work without that. Now, I'm not a fan of The Lion King. It's not actually that I've ever seen The Lion King, but if we were meeting at my office on each side of the front door to the building, there are lion gargoyles. And so, ergo, that's how I got the lion behind my head as my firm's logo. There are two disclosures which I have to give. And the first is that I'm not providing legal advice tonight. We're going to be talking about some general provisions, but nothing that is really specific. I can't claim that we're providing legal advice. And of course, this is kind of obvious, but I have to say it, nothing here is confidential. We don't have that typical lawyer-client confidentiality going on. So we're going to start with an overview about estate planning, what you need to know and why. Can I have that first slide, please? Now, what happens if you do nothing? Don't worry, the government has a plan for you. The government will take care of you. That's called dying intestate without a will. Now, for some people, the government's plan is actually the same as their own plan would be, because generally what happens is your worldly assets go to family. The problem can be, though, maybe it's not the family members that you really like, or the amounts aren't really what you would like individual family members to get. So I think it's probably a good idea for everyone to listen to the rest of this show today and probably end up with an estate plan and to do some financial planning. Now, there are two components to everyone's estate. That is, there are what we call probate assets, and then there are non-probate assets. And a will deals with the probate assets. It does not deal with the non-probate assets. And so even if you don't have a probate estate, and we'll talk about that in a little while, you still have an estate. It's just called a non-probate estate. And what we have here is a definition of what these two are. The probate estate is an asset that requires a signature after your death to transfer ownership. Now, in a will, you appoint the person who gets essentially that signature power. If you don't have a will, the government has a list of folk who can get appointed to essentially have your signature as the dead owner. Kind of the classic items that need a signature: car title. If you've ever bought or sold a car, in that upper right-hand corner, you got to write your name real small. Okay, in order to sell or buy a car, a signature is required. To buy property, if you have a condo or a house, you had to sit at that settlement table and sign your name a lot. Well, the same when you sell it, or if your estate sells your car or your house or condo, signatures are required. Now, I should specify that that's real property if it's only in one person's name, because if it's jointly owned, that property becomes a non-probate asset when the first person dies, because by act of law, it transfers automatically from two people owning it to one person owning it upon their death. Okay, Eric's going to talk about brokerage accounts and other investment products. Probably if you have those, when you've opened them up, the bank or the investment advisor has asked you to fill a beneficiary form. The moment you die, that beneficiary kicks in, and that asset ownership transfers the moment you die. No signatures required, because essentially you did the signature before you died. Next slide, please. So you have these worldly assets, and you have probate assets, ones that can't be, that a signature required after death. And so now you have an estate plan, or the beginning to have an estate plan, as you think about how to deal with those probate assets. Last will and testament is the classic vehicle that people deal with, address how they want to disperse their worldly assets upon death, their stuff and their money. Now, there's also powers of attorney, and we're going to get into each of these elements of an estate plan in turn. You notice in parentheses, I say, and perhaps a trust. What is a trust? So I've said probate is essentially the court giving the dead person's signature, someone going down to the courthouse and asking the court, pursuant to a will or pursuant to a statute, to get the dead person's authority to transfer assets. Now, a trust is a structure that can hold assets that you might own while you're alive. Think about it like an umbrella. And if you look up at an umbrella when you've opened it, there are these ribs on the umbrella. And think about putting your assets, hanging them on the ribs of the umbrella. So you put your car title on one rib. You put the title to your condo on another rib. You put maybe some of your bank accounts, your investment accounts, and you put those under the umbrella. Now, you as the grantor, as the person who created this trust, are holding the shaft of the umbrella while you're alive. You're known as the grantor and the initial trustee. And if this is like a common trust, a revocable trust, you can change the terms of the trust while you're alive. What do I mean? So when you die and your hands drop off the shaft of the umbrella, your successor trustee automatically is there and is grabbing the umbrella and is keeping control of the trust after you die and is doing what you wanted pursuant to what you said when you created the trust. So the trust is kind of a seamless process. You create it while you're alive, and then when you die, it continues. And whatever you've put under the trust continues to be in the trust after you die and gets administered by the terms of the trust. Now, it sounds complicated. It's not tremendously complicated, but it is a little bit more involved than a simple will. Now, if you have a trust, you still have a will, because people sometimes forget to put things in the trust, or they don't want to put everything in the trust. And so you still need a will to either pour over everything into the trust or to address those things that you don't want to put in the trust. Now, why might you want a trust? So, if you have a complicated financial picture, if you have more than, let's say, a bank account and a checking account, it simplifies the cleanup, the disbursement of assets after you die. If you have property in more than one state, real estate in more than one state, it certainly simplifies having to address the sale of those properties, because you don't have to go down to the courthouse to get authority if you put them up under the umbrella. You don't have to go to another state to open up ancillary probate, essentially a second probate. There's privacy. Some people like the notion that their estate plan is not publicly known because a will is publicly filed. In theory, it's a little quicker to make gifts because you don't have to go down to the courthouse. But I have to say, there's a lot of rigor required if you have a trust. And a lot of people don't do the spade work to really make it work upon their death. For example, they don't change title for the car, or they don't change title to their house. And so you actually might create more work for those who clean up after you, because they then have to move things into the trust before making the gifts that you wanted. All right, so wills, trusts, what are some of the other documents that make up an estate plan? The healthcare power of attorney and advance directive, very important because it gives you peace of mind. Now, some people call this a living will. What it does is it establishes the standard of care in case you can't make decisions for yourself, and it appoints an agent to make those decisions for you. Now, here there's a real important key, and that is that you pick someone who is going to do what you want, which may not necessarily be what he, she, or they would do for themselves. I call it having the Thanksgiving conversation, because a healthcare power of attorney has a lot of words in it. But what you really want is someone who appreciates who you are, who appreciates what it is that you want. And so as a lawyer, I try and draft what it is the client wants. But there are nuances when it comes to end of life. And it's really important that the person that you have appointed knows and appreciates who you are and what it is you want. The general durable financial power is really the power kind of the pen while you're alive. the power to make business decisions, pay your rent, if you're in the hospital for a long time, to get you a New York Times subscription, or if you can't read, to cancel your New York Times subscription. But anything that's kind of non-medical, you're appointing an agent to be able to do for you. Now, here the key is that this is a person you trust because they have access to your money. And what flows from that is that if someone knows how you spend your money, they know really everything about you. So it has to be someone who's not going to be shocked when they learn that you have the foremost collection of Beanie Babies, which actually happened to a client of mine. Thankfully, she was in the hospital for quite a while, but eventually got out. She's totally fine now, other than her family does continue to rib her at all family gatherings about her collection of Beanie Babies. I should say that, yes, these documents, well, actually, let me go on next to the next document. Disposition of remains sounds exactly what it says. It deals with what happens with your body. Early on, when I started practicing, I would let clients say things like cremation and nothing more. And then what I realized over time is that's not really very fair to those people who are left. Because what happens if you just say cremation is that you run the risk of being a shelf person. That's what morticians call people who just end up on some closet shelf because their family didn't know what to do with them. And so I now really try and get my clients to take that extra step and, like, what should they do with the ashes? So, give a little bit more thought. This is the place if you have some favorite music or if you have a particular passage from a religious book that you want to have read, if you want to have someone speak, this is the place to put that in. Some people think it should go way back up on the list there and be part of a will. The issue, though, for most people is that they're already burned up or in the ground before their last will and testament has legal authority, before someone has gone to the courthouse, and so it's too late. HIPAA disclosure, of course, you have to have one of those. That allows your agents to get the the medical information, that they need in order to make wise choices. Now, you can find many of these documents online. The problem is, though, I think, do you know which version of a will or a healthcare power of attorney or the general durable financial power of attorney to use? I really do believe that spending a little bit of money today can save your family, your friends, a lot of money in the future. There's really no value-free drafting out there. So, for example, I start, unless my client says otherwise, with the healthcare power of attorney to emphasize quality of life. With the general durable financial power of attorney, I start from a premise that you are picking someone who you trust and who you want to make it as easy for them to do that which they think is in your best interest. Now, other attorneys draft these documents very differently. Some people have different philosophies when it comes to end of life. And certainly some lawyers draft a financial power of attorney much more defensively and really try and limit that which the agent can do for you. We're now going to segue. And I realize, of course, that there are questions. And so there's plenty of time afterwards to ask those questions. But we're now going to start segueing to Eric and to, and I'm going to help put kind of a philanthropic frame around the time that he's going to spend with you as it comes to financial planning. I really like this slide because it tells us what I think intuitively we already know. And that is that people don't give to charities because of a tax reason or for some other financial sort of reason. I mean, they really give because of an emotional connection that they have with the good work that a charity is doing. And then the last slide that I'm going to show is who gives. And, you know, I think it's obvious, right, that boomers and seniors are the ones who give the most. But what I think is really interesting here is that we're seeing millennials and Gen X, we're seeing younger folk beginning to kind of pick up the slack and become a little bit more involved in philanthropy. So I'm pleased that you're with us, and now I look forward to learning more from Eric.
Okay. Thank you, Lars. Appreciate those comments. I'm hoping I'm coming through loud and clear for everyone. I'm delighted to be back supporting Food and Friends again this year, and I've been asked to teach the group about some of the basics. And so I'll preface these comments by saying there's lots and lots of exceptions. Uncle Sam never makes things easy, as everyone on this call knows. But I'm going to start off by talking a little bit about something that's near and dear to my practice, is the individual retirement accounts. And individual retirement accounts, IRAs, are one of the most attractive long-term retirement savings vehicles available to investors. And it allows IRAs allow you to grow your wealth in a tax-advantaged manner. I'll tell you a little bit about different ways we can do that. And the tax advantages are really Uncle Sam's trade-off for incenting you to take care of yourself, really, down the road. And so there are two types, when we reduce the sauce down, two types of IRAs that we need to concern ourselves with: the traditional IRA and the Roth IRA. And I'll tell you a little bit about contributions and distributions from each. We'll start with the traditional IRA, and for the most part, well, I'll say traditional IRAs can accept pre-tax money and after-tax money. The vast majority of all assets we find in traditional IRAs are pre-tax money. And so the significance of pre-tax dollars is that your tax, the tax incentive and the tax advantage you receive is upfront, in the dollars. When you contribute pre-tax dollars to an individual to a traditional IRA, you're getting a tax break upfront if your contributions are deductible. So on a related theme is pre-tax deferrals to employer retirement plans and 401ks and 403bs. I'll set that aside for the moment. Again, the dollars in these traditional IRAs grow on a tax advantage basis, meaning the taxes are deferred until distribution, meaning any dividends, any capital gains, that sort of income is not taxed along the way. And so you can think of traditional IRAs for the most part as getting a tax break up front, growing on a tax deferred basis, and then you're taxed upon distributions down the road, presumably during retirement, hopefully during retirement. Now, those withdrawals come out as ordinary income because these dollars have never been taxed before for the most part. Again, exceptions to these rules, but that tax advantage along the way, that tax deferred growth, really allows your money to grow faster through the years helping you build your wealth, helping you to build a nest egg to support yourself during retirement. The last comment I'll make about traditional IRAs that we'll get into in a little bit more detail in a moment they are subject to required minimum distributions. That second bullet point you see on the screen, and I'll save that detail for a moment. The second kind of retirement account is of IRA are the Roth IRAs. Senator Roth came along and he questioned the premise of the traditional IRA, which is deferring income when I'm in a high tax bracket and recognizing it during retirement when I'm presumably in a lower tax bracket. Senator Roth said, that sounds great, but what if that assumption is wrong? Senator Roth said, what if I'm comfortable right now at the tax rates that I'm paying? Or what if I know that I'm going to be subject to higher rates down the road? What happens if Uncle Sam raises income tax rates? What happens if I get a large inheritance? What happens if both of those things come to pass? So Senator Roth said, I want a tax vehicle that allows me to lock in, know what I'm paying in terms of taxes now, and then never again. And so there's the premise of the Roth IRA. After tax dollars go into the Roth IRA, they grow tax-free, and in the distribution phase, they come back out tax-free. So personally, I think they're the greatest thing since sliced bread. But in the end, when we're doing retirement planning for individuals and families, we want to be diversified from not only the pre-tax traditional IRA dollars and the after-tax Roth IRA dollars. We might want to put a third category in there, and those are taxable dollars. So as I explain it to clients, traditional IRAs are pay taxes later. Roth IRAs are pay taxes now and never again. And the taxable investments are pay as you go with after-tax dollars. So that's kind of how those work. And again, I'm happy to field questions about that as we get a little bit closer to the end. Next item, as I mentioned, the required minimum distributions. So Secure Act 2.0 was a piece of legislation that changed what all of us knew about required minimum distributions all of our lives. And that, in our minds, we knew that when I get to 70 and a half years old, I'm going to have to start taking money out of my 401k or traditional IRA. Again, out of my pre-tax retirement accounts. And that rule changed when that legislation came out a few years back. And that new number to plant in the back of your mind is now 73 years old. For those, and it is set to rise to 75 over the years. But right now, for the majority of the people on this call, the number is 73. Now, what does this mean? So Uncle Sam essentially has given you this tax advantage for all these years. They've allowed you to accumulate wealth, and they've allowed it to grow on a tax deferred basis. And now they are ready to tax it. And so at the end of each year, when you become 73 and a half, the value of these pre-tax accounts is divided by your life expectancy. And the resulting math is your required minimum distribution calculation. And you must take those dollars out before year's end, each and every year until you die. Okay. So that's probably put a bow on that. And the last bullet point here is the qualified charitable distribution. And this has become one of my favorite strategies. And so for those that are lucky enough, and we can probably move on to the next slide, if you would, please, because there's a little bit more detail about this. And it's the second bullet point with all the hash marks underneath it. The qualified charitable distributions were not affected by the Secure Act 2.0 legislation. By that, I mean I'm going to call them QCDs going forward. QCD timing is allowed for those that are over 70 and a half years old. So that date did not change along with the required minimum distribution date, which is now 73. So the nice thing about QCDs is that after age 70 and a half, and not a day sooner, that doesn't mean the year you turn 70 and a half, but after you reach age 70 and a half, you can begin to donate your pre-tax assets, perhaps to Food and Friends, for example, and you cut Uncle Sam out of the equation. Those distributions move from your IRA custodian, the company that's taking care of your dollars, directly to Food and Friends, for our example, and there are no taxes on the distribution, and nor does Food and Friends have to pay taxes on that donation. And so you've effectively allowed these assets to grow tax deferred for years and years and years, and you have in a very positive way cheated Uncle Sam out of the taxation. So the limit, as you can see there, for 2025 is $108,000 per person. And as I said, it moves directly from your IRA custodian directly to the charity. You're not allowed to receive any benefits. You receive no deductions, but you do not pay income tax. The last item I'll say, for those that are 73 and older, it can satisfy your RMD. So if you are lucky enough not to need your required minimum distribution proceeds, you can instead give directly to charity and it will satisfy that. So as an example, if I had $1 million IRA and my required minimum distribution was, let's say, $30,000 for the year, I could give $30,000 directly from my IRA to Food and Friends or the Boys and Girls Club or a combination of the two, and I am not taxed at all, and I have checked the box that my required minimum distribution have been satisfied. So the other bullet points on this page, the gift of highly appreciated assets. In my practice, another very effective means of supporting your favorite charities is, well, more often than not, it ends up being stocks. So when somebody purchased Apple, for example, years and years and years ago, and it has grown and grown and grown and grown, that becomes a terrific asset to transfer to charities because you avoid the capital gains while receiving some tax benefit of it. The last bullet point, beneficiary designation planning, that speaks to what Lars talked about earlier, the non-probate assets. So when we set up IRAs and 401ks for ourselves, one of the first steps, as he suggested, was that we fill out a beneficiary designation form. It's critically important that we monitor those because changes happen in our lives. People get married, people get divorced, people pass away, people are born, and we want to make sure those beneficiary designation forms stay up to date. Again, when we get to a point in our lives when we are fortunate enough to have enough wealth that perhaps our heirs don't need our IRAs or life insurance policies for that matter, we can use the beneficiary designation form to directly benefit at the end of our lives those causes and those institutions that are most important to us. The schools we went to, the causes we support, and again, Food and Friends is expert in coaching us through this sort of the sort of beneficiary designation planning, if appropriate. Next slide, please. Just a couple of words here, very briefly, about the recent tax legislation that passed. There's a B missing in there. That's the OBBBA, the One Big Beautiful Bill Act. It's a big piece of legislation. I want to say, I recall there are over 250 pages to this legislation, and not one sentence speaks to retirement planning. Or IRAs or 401ks, not any of it. But what is interesting is that there are some changes for charitable giving And so I would suggest that that top right box there, the non-itemizers can deduct $1,000 or $2,000 depending upon you're single or married next year. There's also a 0.5% deductible threshold that must be passed next year. But I would suggest if you're thinking about substantial gifts that aren't a part of the QCD world that we just reviewed, that you speak to your tax advisor. And just a little note about large estates. The estate tax exemption has been permanently set. I'll say permanently written in pencil for now, but a permanent estate tax exemption of $15 million per person, and I'll leave it at that. Last slide, please. And this slide is speaks to, I want to say, the ways that financial planning and estate planning really work in conjunction with one another. So leaving a legacy to your favorite causes is important to a lot of clients, and you can do that in a number of ways. The QCD is one of my favorite while we're alive, but at the end of life, you can make bequests in your will. You can under that umbrella that Lars talked about, one of the instructions that you leave behind can leave funds to your favorite charity, Food and Friends, for example. And lastly, many of us have these life insurance policies to take care of our loved ones, to eliminate the mortgage if the breadwinner passes away, to put kids through school. But thankfully that doesn't happen all the time. And if those old life insurance policies are still in force and still well funded and going strong, and they simply have outlived their original reason for being, the original reason you purchased the policy, then leaving it to Food and Friends or one of your other favorite charities is absolutely and completely appropriate. And that is done, again, with the beneficiary designation. And so with that, I'll turn it back over to Marilyn and Lars and the group, and we'll stand by for questions. Thanks very much for having me.
Great. Thank you, Eric and Lars. I'm just going to spend a couple minutes before we get right into Q&A to share a little bit of information about Food and Friends Legacy Society, which is one of our giving circles here at Food and Friends. And our Legacy Society recognizes our supporters who make that future commitment to Food and Friends, all the different examples that Eric just shared, by leaving a bequest to Food and Friends in their will, by making us a beneficiary designation of a retirement account or another planned gift. And legacy gifts, they're really special to us because they're about our future, and they help Food and Friends now, but also for generations to come, for all those clients who will need us in the decades ahead. And for donors who make this commitment, they're making a lasting legacy here at Food and Friends, and they have this very special impact. So for an estate gift, a legacy gift that's received in the year that it comes to Food and Friends, our policy is 25% of that gift, up to $50,000, will support annual operations. Then the remainder of that contribution will support Food and Friends' current building expansion initiative through the next few years of our campaign that we're in. And once we have finished the campaign for expanding our building, estate gifts will continue to support the future of Food and Friends by being invested in our board restricted endowment. So just a quick example, that if we received a legacy commitment tomorrow of $100,000, 25% of that legacy gift would support our operations this year, while the remaining $75,000 of that gift will be invested in our building expansion. Next slide, please. we have a legacy society of about 80 individuals who have, given us permission to share their names of support in this way. And really anybody can be a member of our legacy society, and we invite you to consider this type of support. These gifts don't have to be complicated, as Eric and Lars were sharing, and they can, be a gift at any level that's comfortable to the donor. And what's also very important about legacy gifts is that these gifts stay in the control of the donor throughout their lifetime. So if there's a life change that might lead to a change in their charitable end of life giving, that's always in the control of the donor. And these gifts cost supporters nothing now to make that designation, and for the future, or to be included in a will, but it allows us to plan, and it also creates that impact, as I mentioned, about caring for those neighbors who are going to need Food and Friends in the decades ahead. And then the last slide that I wanted to share about our Legacy Society is that we always love to say thank you to our donors, and for Legacy Society members, we have some special benefits as a recognition of this incredible commitment. So throughout the year, we have events that our Legacy Society members are invited to join us here at Food and Friends. At our annual gala, that's in the spring, Chef's Best Dinner and Auction, we do special recognition of this giving society. There's opportunities throughout the year to come for personal tours, and we have a special listing specifically on our website of all the donors who have made this commitment. So as you continue thinking about this planning, there's lots more information on our website using that URL about plan giving. And of course, if you're interested in learning more, the next slide you'll see that we'll leave up for a while is all of our contact information that you have for Lars and Eric, myself, my colleague Buffy, who's on the call. Please reach out. We love to connect with our supporters and would love to continue the conversation from tonight. So without further ado, we're going to start with Q&A. Please, again, if you have questions, put them in that Q&A box, but plenty to start with from advanced questions. So I'm going to ask Eric to also turn on your camera, please. And I think I'll start with Lars, since there was a slew. I would put it under the umbrella of questions relating to all the different documentations you shared for the estate plan. So we have a few questions kind of drilling down some more regarding those different documents. So the first one is, where should I keep my will and the other documents you mentioned? And should I tell people that I put them in my will?
So where you keep your will, let's start with that one. It used to be that lawyers would keep wills for clients. And there certainly are some lawyers who do that, and it's that's an option. Personally, and I think kind of a newer trend is that clients should keep their own documents, because if in the middle of the night you want to make a change, or if you want to change your lawyer, you shouldn't kind of be held hostage, and you should have more control over your documents than having them at a lawyer's office. But that's an option. In Maryland, courthouses have will repositories, and the courthouse will hold wills. It's a similar issue, though, if you decide that you want to make a change on a 3-day weekend and holiday weekend and the courthouse is closed. That can be an issue. If you have a safety deposit box, that's a great place to keep a will. There's a whole protocol in every state that allows for a safety deposit box to be opened up, and the lid's opened and everyone looks in. And if there's a will, it's allowed to be taken out following certain procedures. So if you have a safety deposit box, that's a good place. If you work in an office, I've heard of people keeping their wills in their file desk drawer, in an envelope marked confidential, because office buildings don't burn down. I've heard people put their wills in their refrigerator or in their freezer, wrapped in plastic, all sorts of places people put them. I'll tell you that my estate plans are in a file cabinet in my house. I have told people that there's a red folder, and in that folder are those end-of-life documents, are some information on bank accounts, not the actual account numbers, but just that I have a bank account at X bank. That's really all you need. You don't need the passwords because upon death, the properly appointed individuals are going to be helped by those financial institutions. So there's really not a good answer. I'm sorry. Yes, I would tell people where your wills are. I tell them that no surprises. Whoever's going to be your whoever is going to be your personal representative or executor, they need to know. You need to have asked them. Whoever's going to be your power of attorney for healthcare issues or for financial issues, you need to have asked them and gotten their permission. Whether you give them the documents beforehand or you just tell them where the documents are, that's really a matter of kind of trust of the individual and personal choice. Do you tell someone that they're in your will? So there are two competing thoughts here. Again, no right or wrong answer. One is, yeah, if you want to buy love, and I'm being a little facetious, but I mean, if you tell people they're in your will, then, they might pay more attention to you. But what happens if you take them out of your will and then they learn it after you die and you put, I don't know, their sibling in place of them, and maybe they don't get along with their sibling? Ooh, ouch, what have you done? So I'm personally not a big fan of telling people because I think it may box you in later on in life.
Great. And then another question that was received before tonight is, who can be considered an executor if there's no family available?
Well, and sometimes family is not the best choice because if they're, if it's mama or papa and there's some sibling rivalry and you pick one sibling, that doesn't always make the best dynamic for the surviving family members. But to answer that question, friends can serve. If you're in a faith community, someone who you attend service with, you can hire a professional like a CPA or a lawyer. I think financial planners tend not to be able to serve for their clients. There's some fiduciary conflicts there potentially. It can be an issue. One of the things I would suggest is that you get someone younger than you are. Now, this isn't so important, when you're maybe up to in your 60s, but after that, you probably want to start having at least one youngster on your list of alternates in case your primary person can't do it. Because look, a bunch of 80-year-olds may not be the best person, and I'm not an ageist, but you may want to have someone who's a little younger do that job.
Great. So one more question for Lars, and then we have some for Eric. So one question that was just added to the chat was regarding trust. Is there a way to set one up that doesn't require monthly fees?
Yes. So I think where the question is going is, do you have to use a trust company to manage a trust? And no, you don't. Trust companies are either standalone or they're associated with banks or financial services companies. They tend to have a wide variety of more sophisticated investment vehicles. They're also more than likely going to be kind of one-stop shops in terms of they're going to handle taxes, they're going to handle the information requirements to the trust beneficiaries. They have legal fiduciary responsibility, so they're going to be doing everything in kind of a more knowledgeable manner, because this is not the first rodeo, if you will. But no, you don't have to use a trust company. You can use a relative. You can use a friend. Depending on how complicated the trust is, I think that can be, if it's not so complicated, that can be very viable, especially if the trust is not going to last that long. Right now, I'm doing an estate plan for someone who is interested, because of a divorce scenario, to just potentially lock up some money for 2 years. I think that's very easy for some family member to administer a trust for someone for 2 years. You invest it fairly conservatively. You file yearly taxes, and you make an accounting of that which goes in and that which goes out, and you present that to the beneficiary. Now, if there are all sorts of complicated conditions about how trust monies can be spent, what they can be spent for, if the trust is going to last for, 40 years, that might be a different scenario. Some family member or friend might not really be interested in being a trustee for 40 years.
Great. Thanks so much, Lars. So Eric, turning it over to you, question is it better tax-wise to give financial gifts to family members with my RMD than keeping the money?
Is it, once more?
Yes. Is it better tax-wise to give financial gifts to family members with my RMD than keeping the money for myself?
Assuming, I'll answer the question with the assumption that that the individual does not need the RMD proceeds, and would suggest that there's no wrong answer. If you don't have a taxable estate, which again, $15 million, pretty high level, then reinvesting RMD proceeds can be appropriate, knowing that those heirs will eventually receive those dollars when you pass. However, if your retirement is secure and you're confident enough to give those proceeds away, then I would say you might enjoy watching those folks that you might gift those dollars to, those proceeds to. They might benefit more from a gift today than at the end of your life. So with almost everything in financial planning, that was a long-winded way of saying it depends.
But you're still paying taxes on that distribution versus if you gave that gift to charity.
Absolutely right. So remember the distributions surrounding the taxation surrounding RMD distributions. Uncle Sam is looking to tax those dollars for the first time, and they've been waiting a long time to tax those dollars. So anything, when you initiate your required minimum distribution, that is a taxable event. So you're going to recognize the income there. So what I was referring to was after you've made the distribution, presumably you've had some withholding to Uncle Sam and the district, or Maryland or Virginia, perhaps. The after-tax proceeds can be reinvested or can be gifted. Now, if you prefer to support Food and Friends, for example, you could go the qualified charitable distribution route and give some or all of that required minimum distribution as a QCD and avoid that taxation. That might be nice as well. So again, it all depends.
Great. And then we're nearing time, so let's use the last 2 minutes. Not sure who wants to take this question on, but the final question is, someone is interested in leaving a gift to charity in their estate plan, but they don't know how much is going to be left at their death. How do they determine a beneficiary amount?
Well, I
take a-
think that's
You want
actually
to take a
pretty
stab
easy.
at that, Lars?
Yeah, I can handle that one. I think it's pretty easy.
Okay.
You really should use, it's generally advisable to use percentages for gifts versus actual dollar amounts, unless you're trying to satisfy a pledge or something where there's a hard, fast number, because you can end up with some residuary, if you will, that's not allocated, especially if the estate plan is done early on and the death occurs a long time from now, and we might hopefully have invested some monies with Eric, and we now have more money. And so those percentages are really the way to go. And that means too, if times are hard and you need to live off of investment principal and you end up having less at the end, well, your estate plan is automatically kind of recalibrating, and you don't have to be making dollar amount adjustments and doing codicils, which is a term to make an amendment to your will.
I might add, down in the trenches, when we're dealing with IRA beneficiary designations, if one has, say, a $500,000 IRA, you might carve off for a new IRA plan $50,000 as an example to leave to charity. It'll grow between that moment and your death, where the remainder, the $450,000, you could leave to your son and daughter equally, or your grandkids, or something along those lines. So that's the beneficiary designation is really very powerful, and when given a lot of thought can accomplish a lot.
Great. Well, thank you for your final thoughts and for joining us tonight and sharing again your wonderful expertise on this really important subject that everybody should be aware of. So thank you also to the attendees. We appreciate your support of Food and Friends, your interest in this topic, and we had a lot more questions than we were able to get to. So again, please reach out so we can, have a dialogue, continue the conversation. And thank you again, and have a wonderful night.